Hello everyone, happy Sunday. I think personally the best trade that you can make right now is to get into puts for 2 months out. In today's video, I'm going to explain to you guys my exact thought process of why that is the case. We're also going to take a look at the SP500, the NASDAQ, the Russell, the dollar, the bonds, the VIX, the large tech stocks. Put everything together. We're going to take a look at what the news is for this week as well. And we're going to take it one step at a time. All right, without further ado, let's get started with the video. So what I want to look at first and foremost with you guys is the MACD indicator and what happens in history when we get this high on the MACD. All right, so we're looking at the 3-10-16 MACD. It's not the normal MACD. This is a bit faster, okay? So what specifically I want to look at is when this orange line basically is this high, which is the slow MACD line, what happens to the price action on the S&P 500 moving forward, okay? So currently we can see that the orange line is very, very high, okay? So now we're going to go in history at different times to see what ended up happening to the SPY when we were this high on the MACD. So the first most recent time in history where we ended up getting close to that height on the orange slow acting MACD line was back in August of 2022. So we could see the price action that ended up occurring here. Basically we ended up you could see that we started to get close as the price ended up going a bit higher here, right? And this ended up making another high, but it really dropped very heavily. This was, that big bearish move downside back in August. So we ended up making new lows and breaking the point where we initially started getting close to touching it. So that's the main thing that I'm trying to show you guys. What ends up happening? Do we end up ever being profitable in the puts if you were to enter puts? And the answer for, getting into a month and a half out, 2 months out puts, the answer is yes on this instance here, okay? Time prior to that was in April of 2022. Basically the big March run up where we hit 462. What ended up happening afterward, everyone knows. We got close to this level, right? And then we ended up making newer lows again. Okay, so this was another point where as the MACD got very high, the market ended up really capitulating and getting into puts for a longer term, ended up being profitable. The next point, not as clean, but November of 2021, when we made these highs as well. Had we gone short up here for a month and a half out, obviously this would have also worked. Okay, so this it's an honorary mention. It's one of the honorary mentions. We could see that it's still a bit far away. You could look at the orange MACD line. It's far away from where we are currently on the MACD. But even had you gone short over here, there was still a bit of a pullback. So you would have been profitable here as well. So this is one of the instances. Also a bit of an honorary mention. Still a ways away. But had we have gone short over here with some time, this would not have worked out. The market ended up continuing to pump. And this was back in November of 2020. So this was post COVID crash, and we were getting a lot of injection from the Fed into the stock market as well. So this, just did not work out. This one did work out back in June of 2020. See that the market ended up having a topping pattern, had a big pullback, and then right afterward, right before this was in April of 2020 as well, would have gone short, and multiple instances here would have been in profit. There was a pullback. So what does that mean immediately for the market? Get some context. Number one, there has been a lot of institutional buyers entering it, right? Number two, we are at historical levels where on the MACD, if we get to these levels, there tends to be a pullback within a month and a half. So going short, once again, for a month and a half, 2 months out, would be a high quality trade. Number three in terms of context, we've already made a very big move to the upside. Granted, we can easily make another move to the upside. That, as we saw in August prior, right, where we made another leg up, and then we ended up dropping back in August 2022. That is still also really possible. But overall, so here's the thing. Using data is very, very important, but there's always that chance where it doesn't work out. And in that instance, that's why we want to get time along our trades. We want to make sure that we're entering with enough time on our contracts. And we don't want to be married to a direction. But at the moment, based off of what we just saw, and based off of a few other things that I'm going to show you guys, we could remain up here for the next few weeks, potentially, right? We could, pop around up here. But overall, going long up here is very, very dangerous. And I, am waiting for a bit of a pullback, as everyone else is as well, for a bit of a pullback before running back the market up into December and January. So next, let's go ahead and take a look at what's going on with the yields. So the yields tend to have an inverse relationship to the market. As we can see, the yields are at the lower edge of this channel, as well as a falling wedge pattern on the yields, which is generally a very bullish pattern. And you can see that we are starting to break out. Generally, the yields have an inverse relationship to the market. So as the yields continue to show some strength, we should start seeing weakness in the overall market. So far, this is definitely starting to look like a bullish transition on the yield, which is bearish for the overall market. So pragmatically right now, the dollar is also in a bit of a falling wedge, but we can see that there's a few interesting things on the dollar. The MACD line has crossed above, and generally that is bullish, which means that we should continue up, right? But the issue is that we are failing at the level of resistance here, and there is still more room to go to the downside, which would cause a new low on the dollar. We would break this low to retest this lower trend line. So similar to what's going on with the yields, the dollar is in a bit of a similar pattern. So this down here would be a better opportunity for a rip to the upside. But in general, the dollar also has an inverse relationship to the market. So this is a bullish pattern on the dollar. What happens in the next few days is yet to be seen. But overall, this is a bullish pattern and tends to break upwards. And if the dollar tends to break upwards, because it has an inverse relationship to the market should fall. All right, so we're going to have to see day to day if that ends up being the case. And last but not least, taking a look at the VIX. So the VIX also has an inverse relationship to the market. When the VIX is falling, that is generally good for the overall market. So to give a bit of context on what's going on with the VIX right now, we are very, very low on the VIX. The last time we've been trading at this level was back in January of 2020. And we know what happened the month after. But the issue with the VIX at the moment is we can remain trading down here for a few weeks. The VIX can remain like this because, as we've seen, institutions have been trying to keep the volatility beaten down lower. But we can remain this low by all means. This is not just because we broke down to these levels again does not automatically mean that we're going to bounce on the VIX ASAP, which would cause a drop in the market. That's why it's important to enter puts with time. And I really, really think that, especially as we get down to this $12 level, even $11.50, these are good levels of support on the VIX. But the thing is, timing to go against strength is much more difficult than timing the market to buy dips. So in general, right now, what I will look for a sharp drop in the market is if we end up getting a sharp drop in the VIX, which should be bullish, right? So if we get a sharp drop in the VIX and we drop back down to this trend line, this would also be another falling wedge. We're similar pattern across the board on the dollar and the yields. But if we get a big move to the downside on the VIX, this would be a much more comfortable time to go long on the VIX. and being bullish on the VIX means that it's bearish for the market. So this is another thing that I'm looking at here. For a VIX to get like a nice, solid, aggressive move to the downside, if that ends up occurring, that would be a good time to go short on the. That's why having time on puts is very, very important. And I'm gonna explain what I mean by trying to short strength. So what I mean is basically when you see extreme strength, right? It's difficult to time a drop because we can continue to go up because algorithms and bankers are institutions are buying in. So the people that are late, they're going to continue to buy in and they're not going to want this to drop. So they're going to inject more and more capital. So as we can see, there's been multiple times where that's occurred. You know, over here, we were overextended. If you were trying to go short over here in July, we still made another leg up. But then afterward, with time, we ended up falling lower. Going short into strength is much more difficult than blindly. I mean, not blindly, but you can be a way more aggressive with your expiration dates if you end up if the market is falling. Okay, so it's way easier to do that when the market is showing weakness because people are going to buy dips much more aggressively. So you know, time and time again, we've seen just buying dips ends up being much, much easier than trying to catch tops. And trying to catch tops, you have to enter with more time. When you're trying to buy dips, you don't need to enter with as much time. Those 2 or 3 week out contracts end up working out easier. But if you end up trying to short the tops with 2 or 3 week out contracts, that generally doesn't even work. Yeah, so I hope this makes sense and brings some clarity. So the main tech stock that I now want to look at is Nvidia. And Nvidia and the chips have been a very, very major reason why this move to the upside in the overall market has occurred. And this trend line on Nvidia is very, very important. So initially back in September, we were riding this trend line and bottoming out here, which caused a huge run up in the market. So the market was falling while Nvidia was bottoming out. So Nvidia bottoming out and showing strength was a precursor of what was yet to come in the market. So this was a good indication. These candles here were a good indication that the market was bottoming out. And as you know, this was a very, very important trend line. We've tested it multiple times, and you could see that we broke above it and then retested it back here in January. Then we came back and closely almost retested it back in February, back in March, and then we really tested it multiple times all throughout here in April and to the end of May. So then, you know, we came back, retested it here recently in September, broke below it, caused another move to the downside. Now we're back. So what happens here is going to be really, really important for Nvidia. And my thought process is if Nvidia starts to really show some weakness, that weakness, another stock or another sector is going to have to pick up the slack. And it's never a good sign to see large tech stocks beginning to show a lot of weakness. So if Nvidia starts showing some cracks, we're going to need Nvidia to hold these very important support levels. So the main one is going to be at 460. If Nvidia starts to show a lot of weakness, but the market is still showing a lot of strength, and you know, like, it'd be interesting. But if Nvidia really breaks below 460 with strength, then that's not a good sign for the overall, in my opinion. Of course, honestly, just shifting through all of the large tech stocks. So, of course, when you're looking at the other large tech stocks, Apple, Microsoft, Google, Tesla, Amazon, Meta, these other large companies, they're either at levels of resistance or, you know, they're still showing some sort of strength. They're not extremely, extremely weak. But then when you look at Nvidia, Nvidia is clearly the weakest as of the most recent times. So this could be a very big warning signal. If Nvidia starts to, pragmatically, this could be a big warning signal because Nvidia was one of the leaders. If Nvidia starts showing a lot of weakness and breaks below 460, that can be a bit worrisome for the overall market, in my opinion. Next up, let's just look at what news there is for this week. We have consumer confidence data coming in Tuesday, and then we have preliminary GDP numbers coming in Wednesday pre-market. Then, of course, unemployment claims coming in Thursday, and then Friday we have Fed Powell speaking at 11 a.m. and 10 a.m. we have ISM manufacturing PMI data. All of this stuff is also going to be really important. It's going to be interesting to see how Fed ends up closing the week and starting the new month. And of course, it's always good to keep an open mind because seasonality-wise, the end of November ends up being very, very bullish. Into the beginning of December, we get a bit of a dip. But then in the middle of December, we have another rip to the upside, seasonality. And November and December are both generally very, very bullish months. 75% of the time in November, we're bullish. 70% of the time in December, we're bullish. Lots of bullish indicators, clearly, right? But trying to chase now is very, very difficult, in my opinion. So with all of these different reasons, with Nvidia showing this weakness, with yields, the VIX close to a level of historical support, the dollar showing, well, this is going to be a very, very interesting next few weeks in the market. So overall, the highest quality trade, in my opinion, is still going to remain grabbing some puts for a month and a half. That would be the safest trade. And then as we end up going higher and higher, if we end up breaking higher and higher, that's when we can get a bit more aggressive to buy a month out. If you end up breaking above higher, bit 2-3 weeks out. So this, at the moment, safest trade, in my opinion, 1.5 to 2 month outputs with some stop losses. And it is what it is. But right now, it's going to be tough. It's pretty tough to start leaning aggressively long, in my opinion. But I hope this video makes sense. I hope you guys have a wonderful Sunday. Hope you guys get plenty of rest. We're going to end this week very strong, and the next month is going to be really interesting. So that begins Friday, and yeah, it's important to see how they also end the month. If they want to pump the market up, keep it up for this week, and then maybe we get a bit of a pullback heading into the beginning of December. And then after the beginning of December, after the first week of December, so maybe we keep this up here heading into the end of the month, right? Because they want window dressing, right? And then, first week of December, we get a bit of a pullback. And then we come back down to maybe 452, 453, and then we can bounce off. Let's see. But ideally, what we really want to see is a nice solid pullback that would be healthy for a continued move to the upside into the end of the year. We don't want to see some chop. So ideally, what ends up happening is we make a nice move to the upside, sharp move to the downside back to 450, move back down to 448, and then give some sort of a bottom here, and then rip back up above 460 into the end of the year. That would be ideal. All right, so I hope you guys had some fun. I hope this made sense. And yeah, I really hope the recording and everything worked out. But yeah, please make sure to like, comment, subscribe, do all that good stuff. And I will see you guys bright and early tomorrow morning. Thank you.